going to look at the economy. What's going on in the world, both from a long-term trend perspective, forecasting numbers, and then what are some of the policy issues that we're dealing with here in the States. Why is this important? Because a business operates within a broader economic environment other than itself. It's dependent on what happens in the world, defines the demand for the product, it demands the price for the product. There's so many things that are decision making, and decisions in a firm are what finance is all about. Finance gives managers information to make a decision. They make a decision within this broader economic environment. So let's start with some basic assumptions that are reminders from prior courses for you. Price is determined between a willing buyer and a willing seller. So that's the first thing to remember. It's a buyer and a seller. Price is influenced by the relationship between supply and demand. So if supply exceeds demand, the price goes up. If demand exceeds supply, let's back up. Let's go back and review some basic economic assumptions, because these things hold true in the firm. Price is determined by a willing buyer and a willing seller. So it's a negotiated price. And this can be done at a macro level or a specific transaction level. Oftentimes what we see when it comes to consumer products is an overall picture of demand. Price, though, is directly related to supply and demand. So if supply exceeds demand, the price will go down. If demand exceeds supply, the price goes up. And we've seen that happen with oil, but it includes not only products, but services, but more importantly today as we look at it, it includes labor. Okay? And there's a relationship that exists between product, services, and labor. If there's no demand for the product, there's not going to be a demand for the labor. So there's a direct relationship there. And where we are, and we'll see as we move forward, that labor is becoming in short supply for a number of reasons, which we will talk about. Let's look at, there's really two different things to look at. The first, let's talk about the economy. What is happening today? This is mostly data-driven, and a lot of it is historical, what has happened in the past. It's a measure of society and how it is behaving today. There are some forward-looking measures, but a lot of what we look at are historical. So that's what's happening in the real economy. Then we look at the financial markets, which we'll be talking more about as we go along. And financial markets are stocks, bonds, interest rates, and oftentimes that reflects what has happened, but more importantly reflects what happens in the future. Okay? So it's different than what's happening in the underlying economy or in the fundamentals of a company. And it's very future orientated. But people make different assumptions about the future. And if you have different assumptions, you may result in different opinions around pricing. And sometimes the market reacts to news, not something that is fundamentally changed, but is reacting to news about the future of something. And the market, to some degree, is really influenced by program algorithmic traders. Okay, that there's computers and there's programs that are driving some of the market movement irrespective of what's happening in the economy. So let's take a look. What are we going to look at? We're going to take a look at global and U.S. trends. We're going to do economic measurements and forecasts, policy impacts, and then how does it impact you personally and the work we will do in this course. We will actually talk about the first two sections and then take a break and come back and talk about Section 3 and 4. What we have is we have some global and U.S. trends that are happening today, and they have been in the process of occurring for the past number of years. Today, in our modern world, because of the internet, everything is connected to everything else. We're now interdependent and interlocked as nations, as individuals, and in businesses as we have never been before. This is fundamental. We're a global society. No more is this seen in the global supply chain. And when you look at the global supply chain, we see we have suppliers, the corporation, and customers. And all of this goes back and forth between countries. So the corporation has got materials management. Where does it come from? Inventory management. Where is the inventory? Physical distribution to customers, and storage. But these are all suppliers getting things into the company, and then the company getting things to customers. And this is the global supply chain. Take something as even simple as food, okay? And when you look at it, you can see that in certain parts of the world, there's foods, that's grains, vegetables, and fruit that come from different places. So simply from food, we are interconnected. And sometimes it is seasonal. Like here in the Northeast, we can't grow a lot of fresh fruits and vegetables from probably November through April. So that's got to come from somewhere else. And when we look at where foods are coming from all over the world, we're tied together by food. Second is when we look at industry, and the best example I can show you is the 787, Boeing 787. Take a look at where things were made. They are made sorry about that. They are made all over the world. The forward fuselage is made here in the U.S. in Wichita. But the cargo access doors underneath are made in Sweden. The midsection is made in Japan. The center is made in Italy. The rear made in Charleston. The fuselage is made in Korea, Washington, Korea, Australia, Japan, California, Korea, Sweden, Winnipeg, Canada, either Derby, UK for the engines, or Ohio, Tulsa, UK. So we got the 787, that this supply chain of putting these planes together is all over the world with all different companies. Now, when you think about that, is why are they made in these different parts? Because of skills, because of availability of parts, and they pull them all together. Okay? So, I think that becomes a very important thing to keep in mind, is that we really have this global supply. Those two examples of food and aircraft are one of many. Now, when we look and we keep going here, what we see is that the U.S. has one of the highest costs of manufacturing. Okay, and we can see Germany is more than us. France is up there, but when we look at Mexico, it's $590. China, it's $412. So I want you to think about something as to why would people want to produce goods elsewhere. It's cheaper. Okay. But what does that mean? Let's look at the basics of accounting. Debits equal credits. So revenues less cost equals profit. So if cash in or cash out changes, if cash in exceeds cash out, there's a surplus, profit. Cash in equals cash out, it's balanced. Cash in is less than cash out, you have a deficit. Where does cash come from? Cash comes from sales less expenses. So if you're currently producing in Mexico and you want to move that to the U.S., your expenses are going to go up. So if expenses are going up, a company either has to make less money, okay, or lose money, which is not a viable business alternative, or they have to raise their prices. And if they raise their prices, the question becomes, will someone pay that higher price? That's really the question that we're looking at with some of these. When we look at the global financial system, it is as tied as the supply chain. Okay, we got currencies, exchange rates, financial markets, commercial banks. All of these are around the world. Okay, and we're all tied together. So you can't just pull apart. So we have this global supply chain, that trend of globalization, which you can't make go away. The next thing, if we look at the size of the world. Okay, the U.S. is down here at 307 million. China's at 1.3 billion. India at 1.1 billion. So the U.S., if you look at it, is a very small piece of the world. Okay, so we got to look. We're interacting on this global stage with much bigger players. We're actually a small bit player when you come to it. But that theme is important for a business to say, where are there opportunities? Do you want to serve 300 million people? Or do you, as a business, if you're growing your business, wouldn't you want to look at a market that has more people? The answer is yes, because there's not enough people in the U.S. to buy all the product that you may want to make. So you have to go global. When we look at the world population and its growth, we can see that developed countries are essentially flat. They are not growing, nor will they. If we're looking at the world population to grow from where we are today to almost 8 billion people in 2050, the growth is coming in the developing countries, not in the developed countries. Not at all. And there's a couple of reasons for that, which we'll talk about in a moment. But look at the size of economies as a share of world GDP. The data is a little bit dated, but it's still fairly close. I couldn't find this chart that was as easy as this one. As you can see that we have 22% of the world's GDP. It's a big number. It's disproportionate to our population. And if we look at the others, we can see the size of Japan, we can see the size of the UK, the Eurozone, which is huge, China, still smaller than us. But remember, that's based on their population that is growing and changing as they're getting richer, as the middle class is evolving. Let's look at it one other different way. Where is the growth of the world coming from? China, the US, India, and then the rest. So we're seeing growth. The economies of India and China are growing much faster than the US. So we now come back to this issue of we got this global growth. That's what's happening. We're population size, we're small. We control a disproportionate amount of GDP, but the market opportunities are clearly elsewhere. But what's happening? Demographic shifts. We're seeing right now, between 2000 and 2050, the number of people aged 60 and over is expected to double. Okay? By 2050, more than 1 in 5 people will be 60 years or older. What we're seeing is, in the world, we're seeing population growth, but the growth is happening in emerging and frontier markets. Okay, frontier markets are Africa. Emerging markets are China and India, Brazil. But what we're seeing is aging of citizens in developed countries for a couple of things. In America, we're having aging. People are living longer and the birth rates have slowed. People are not having as many children and they're having them later in life. In 1950, 8.1% of the population was over 65. Currently, we're at 13.3. When we hit 2030, it'll be 1 in 4. Okay? That results in, we're going to have higher medical costs, no doubt, but they're staying in the workforce longer. They're taking on second and third careers, part-time workers, and there's different buying and lifestyle habits as people age. there's a decline in the workforce in the U.S. and developed countries. So we have this aging going on. That's a long-term trend. There's a hidden cost to the aging, and that is that as the labor force has grown slowly and the people in it are aging, productivity has not increased because older people produce more simply based on skill, knowledge. So they're more productive. So as the labor force is slowing its growth and the older people are coming out of it as they retire, we're seeing productivity drop. That's not a good thing. That's a hidden impact. The other thing that's changing is our mix of race and ethnicity. In 2010, you can see that 65% of America is white, non-Hispanic, with 16% Hispanic, 12% black, non-Hispanic, 5% Asian, and then others. But look at what happens over the next 30, 40 years. We're seeing a huge increase in Hispanic. Huge. While the population of white, non-Hispanic is reducing. So we're seeing this shift in age, ethnicity, and race. Now, I suggest that what you have is U.S. is positioned better than other countries. U.S. population and workforce is growing slowly, but it's still growing. In some emerging markets, China and Russia, it is negative. Okay, and that's going to force the growth rates down in these countries from 6% to 4%. Now, what's happened as a function of this is that we have had a reallocation of manufacturing capacity over the past few years. Eastern Europe opened up in 1989. That's Poland, the Czech Republic, Hungary, and that has given access to a labor force, a new labor force. China didn't open up until 1997, okay, and became part of the World Trade Organization not until 2002. Vietnam and Malaysia. So there's availability of new labor forces to do work at a lower cost. We had the time historically where we've moved towards free trade and regional trade agreements, NAFTA and Eurozone. Those have been in place and have been working. Could they be improved? Sure. But remember, we're an interconnected world. These trends that we saw resulted in shifts of jobs between these different countries. And when we look at that, there's global issues. And all of these global issues are interconnected, whether it be the food supply, whether it be energy, the environment, natural resources, the economy, communication, transportation, and population. We're all interconnected. Okay? These major issues are interconnected. We can't just pull out one and not look at it on a global basis because of that tie. So what we're seeing right now is three fundamental changes, these drivers of change. The demographic shifts, the restructuring of global power as population grows, and disruptive innovation. We got global political change is happening right now. A backlash against globalization. It's already there, but it's led to major political developments. Brexit and Trump being the biggest example. France going the other way. The growing size and role of developing countries. The Middle East, Sunni versus Shiite. Terrorism that can strike any time. And then what's the role of oil? So these are some of the changes politically that are going on. Long-term trends, not just the next year, not the next month. But what we have is disruptors. Okay? Literally uproot and change how we think, how we behave, do business, learn, and go about our day-to-day lives. A disruption displaces an existing market industry or technology and produces something new and more efficient. It's both destructive and creative at the same time. Take a look. The best examples are your smartphone, your Amazon. And if you click on that link here on your notes, it'll give you the top disruptors for 2016. Some of them you will not even recognize. But we have them in technology, we have them in global transportation, and we have them in changing use of energy. So that completes section 1. Let's take a look at current economic growth, measurement, and forecasts. And I think there's a lot of different words, a lot of different assumptions, a lot of people doing forecasts, and there's a lot of moving parts. So it's an estimate at best. Let's start with the most common one, if you recall from your economics class, the GDP. What you need to know about this is what is it and what does it really mean as opposed to how it's constructed. It's generally an indicator of the health of a country's economy. It's a primary one. Okay? If it's a healthy, growing economy, you have low unemployment, wages increase as business demands more labor to meet growing supply needs. It builds confidence. People feel good. If an economy is growing too fast, you have inflation can be a risk. If it's a negative growth, that means there's less jobs, less production. It creates negative feels. So that's what we have. It's an indicator, but it also helps us feel where we are. 2 quarters of negative growth is considered a recession. So that's how the GDP is used. There's total GDP. It's often expressed as a percentage of change over a prior year or a quarter. What is it growing at what rate? And that's the first piece. The second is we're more concerned about trends, okay? Because you can have individual points, but it's the trend that becomes important. It's a very complicated measure because it includes a lot of other statistics and estimates. It's not always timely, preliminary and final. We won't have the final GDP for the first quarter ending March 31st, 2017 until almost the end of May. So we know where it was preliminary, and that was 0.7 growth, and that's pretty low, but it's preliminary. But it's the trend that we're looking for. What is the GDP? GDP is simply the value of all goods and services produced over a specific time period. And it includes all private and consumer spending. That's what you and I as consumers buy. All the government spending, and all of the sum of the country's spending on capital. So that's if we buy something, if somebody who makes something makes an investment to make more, buys more machinery, equipment, software, etc., that's investment. And X is net exports. Our exports less our imports. So that's a very simple formula. You know there's really those 4 parts. There's consumer, there's manufacturing, production, investment, government spending, and net inputs. Let's take a look, though, at the most important numbers. And I thought I'd give you the look of our economy is right about $19 trillion there. And if you look, 13 trillion is personal consumption. Okay? That's the bulk of it. Both goods, services are very big, but then gross private domestic investment, 3, still big. Net exports is a negative 558, meaning we import more than we export. But look at the size of this relative to our GDP. Actually pretty small. We export 2.3, we import 2.8. Okay, so it's not as huge a number, but you see that we do import and export. That'll come back. And we see the government spends as much as the private domestic investment. So we're really looking at the U.S. as a consumer-based economy with consumer bias. It's not people making investment in plant and equipment and the infrastructure, either private or public infrastructure. Okay, and exports or imports are not, when you nail them out, we're about even. So the key thing is right here, is that of our economy, we got almost 2/3 of it is consumer spending. And that's on goods, and more importantly, services outweigh the goods. Okay? And as you can see here, here's the next release date is May 26. So these numbers are based. You can see that it's grown. We're growing very slightly. Now, if you look at the trend, what's happening from preceding periods in real domestic product, we see it's been all over the board. We see it up, we see it down, and some of these appear to be rather significant, but when you look at the highest point that we've grown was a 5% rate back in 2014, and we've sort of narrowed up. We bounced up in the third quarter of 16, that's ending September, and since September we've seen it almost plunge, if you look at that. The fourth quarter wasn't very good, and now we continue to grow. This was the lowest rate that we've had since that right there, that was still not low. This is the lowest rate since we hit this in the first quarter of 2014, which was a bad winter. So we can see the percentage change. If we did draw a line, we'd see a positive line here. The other thing is to see, where does the growth come from? If we look at this chart here, we can see that the growth, the blue is the total growth, and this mustard color is consumer, followed by domestic investment, followed by exports, imports, followed by government consumption. So what we saw in the first quarter is we saw things come down, but the biggest piece of it is we saw consumer spending drop. The consumer is not spending. This is the lowest level that the consumer has spent in the past year and a half. Okay, so if we have a concern, we've heard consumer sentiment is very positive, consumer confidence is is very high, but people haven't turned that into buying. Companies are still expanding, which is a positive sign, and as you can see, exports, imports actually turned to create a positive on the GDP. Government spending was down, but we can see in a couple of quarters, we actually can see that trade negatively impact us. So that's what's going on in the U.S. We got this slow, steady growth. If we turn to China, and China has been growing, they've been growing at a rate of over 6.5% for a number of years, and last quarter, the winter, December 16, the economy grew in the third quarter then in China of 6.7%. Now remember, that's a smaller number, but it's still the biggest growth. When we look at what has been forecasted for 2017, we see the bulk of people, still 60% are at 6.5 to 7. Under 6 is really very, very small. So we see growth continuing in China. The other thing we see is the world economy essentially is flat. And we've seen that for the past few years. You can go in here and you can look that really from 2013 we've seen no growth, basically a straight line. When we look at the real GDP versus consumer prices, we're seeing a couple of estimates in here of real growth. The U.S., we see the U.K. Germany we're actually seeing come back up. Emerging economies, 4.5, led by China. India at 7.6. So we're seeing growth around the world. Some of it is very tempered, and you need to look at it that the advanced economies are not doing that well. Okay. Here, when we look at who's below and who's over, based on the forecast from Goldman Sachs, we can see 2017 an estimate of 3.5, and we're seeing the countries that will be growing that are India, China, Indonesia. Meeting it is Turkey and Australia, but as you can tell, Brazil is on the bottom, the U.S., the Euro, Canada, Japan, and Russia are on the bottom. I think what we're seeing is in some places we're seeing that Morgan Stanley actually sees advanced economies growing a little bit faster within this range, either as a bull to bear range. I think as it's going along here, it's going to probably be in the lower range. Now, there's caution on using the GDP. They reflect how the economy has run in the past, based on what we know and some of the historical things. But it hasn't fully captured the positive impact of technology and improvement in lifestyles of the population. There's other measures of how a country could be doing. Environmental, there's economic, environmental, and social measurements. So these indicators might be a better sense of what's happening. But again, we're looking at what's been historically done. And we're very, as a country and as a world, we're trying to expand that, but it's very complex because there's so many different variables. And trying to assume there's correlation between certain variables, or one is a leading or a lagging or predictive, is very hard to do. Well, we're also seeing more information, and the ability to measure it is becoming more real time. A lot of information is provided real time, and it's changing how understanding and use of information. Is that something that is captured via Facebook, through Amazon? We have a lot of this live time. We have people whose satellites and drones are taking pictures in parking lots to estimate retail sales. So we're really coming a tremendously long way on that. But that gives you a picture of where the economy is, where it's short term it is heading, and we're seeing the gap between the developed and developing world, developed and developing parts of the world. The growth is clearly in our developing and frontier markets. The developed countries are essentially flat to minimal growth. Okay, but that's what it is. Okay, that's a historical measurement. So now let's take a break and move on after